Here at Long-Term Wealth, our entire philosophy is built on discipline, and our guide is always the data. We don't guess, we measure. And today, we're going to apply that same discipline to one of the biggest decisions you'll ever face as an investor, this simple math of patience. So here's the scenario. You've got a sum of cash ready to go. Maybe it's from a bonus, an inheritance, you name it. The capital is there, now what? Do you put it all in the market today? Or do you drip it in over time? This isn't just some theoretical question. It's one of the first real tests of your discipline. And trust me, how you answer it can really set the tone for your entire financial future. So to get to the right answer, we've got a clear roadmap. We'll start with the dilemma itself, why this is such a tough decision. Then we'll clearly define the two main strategies. After that, we're going to let the hard data do the talking. And finally, we'll tackle that classic tug of war between math and emotion to show you the only truly disciplined path forward. All right, first up, the investor's dilemma, or as I like to call it, the problem with cash sitting on the sidelines. This fear, it's completely understandable. Nobody wants to be the person who invests a huge chunk of money right before the market takes a nosedive. The thought of that immediate loss is terrifying, and it leads to a kind of paralysis, where doing nothing feels like the safest move. But as we're about to see, doing nothing, inaction, well, that comes with its own very real and frankly guaranteed risk. So if we agree that inaction isn't the answer, we have to define our plan of action. And really, when it comes to putting that capital to work, you've got two main paths you can take. Path number one is lump sum investing, or LSI. It's exactly what it sounds like. It's the direct approach. You take all the cash you have available and you invest it all at once. It's a single, decisive move. Path number two is dollar cost averaging, or DCA. Now, it is crucial that we get this definition right. This is not about investing a part of your monthly paycheck. That's just called systematic investing. For our purposes, DCA is when you already have a lump sum of money right now, but you make a deliberate choice to break it up and invest it in smaller, regular chunks over a set period of time, maybe over 3 months, 6 months, or even a year. And right there, that's the fundamental difference between the two. With lump sum investing, every single dollar you have is in the market from day one, for better or for worse. It's all about maximizing your time in the market. With dollar cost averaging, a big chunk of your money is still sitting on the sidelines in cash. Your exposure to the market only builds up slowly over time. Okay, so we've defined the two paths. Now it's time to separate the math from the myth. It's time to let the data decide. You see, a disciplined investor doesn't rely on gut feelings, hot tips, or what the talking heads on TV are shouting about. A disciplined investor relies on cold, hard evidence. So to find the best strategy, we have to look back at decades of market history and just see what the numbers tell us. And the verdict? Well, it's pretty overwhelming. A major study from Northwestern Mutual looked at market data going all the way back to 1950. And what they found was that lump sum investing gave you a bigger portfolio at the end of the day, about 75% of the time. The data could not be clearer. 3 out of 4 times, putting all your money to work right away was the winning move. So, why? Why does the all-in approach win so consistently? Well, the reason can pretty much be summed up with a single powerful number. It's simple, really. The market goes up more often than it goes down. A lot more. If you look at nearly a century of data, the market has finished the year higher than it started about 3/4 of the time. And because the market has this natural, persistent upward drift, waiting to invest usually just means you end up buying the same assets at a higher price later. Statistically, delaying your entry is a losing bet. So this data presents a pretty clear conflict, doesn't it? And that brings us right to the human factor, that constant battle between math and emotion. This is the million-dollar question, isn't it? If lump sum investing wins 3 out of 4 times, why is dollar cost averaging so incredibly popular? Why would anyone, including some financial advisors, recommend a strategy that is mathematically worse? Well, the answer has nothing to do with finance and everything to do with psychology. The reason is something called loss aversion. It's a well-known quirk in how our brains are wired. Basically, the pain you feel from losing $100 is about twice as intense as the joy you feel from gaining $100. We are literally programmed to avoid losses, even if it means we have to give up much bigger potential gains to do it. And this isn't just a theory. It was proven by the guys who basically invented behavioral economics, Daniel Kahneman and Amos Tversky. Their work showed, without a doubt, that our financial decisions are often driven by an emotional need to avoid pain rather than a logical desire to build wealth. So let's be absolutely clear about this. Dollar cost averaging is not a wealth maximization strategy. It is a regret minimization strategy. It's an emotional security blanket designed to protect us from the feeling of making a big mistake all at once. It feels safer, for sure, but that feeling of safety comes at a very real cost, a lower expected return on your money. All of this leads us to our final conclusion, what we call the disciplined path. This is the official long-term wealth verdict. I want you to think about your capital like seeds for a harvest. Step 1, holding cash. That's like leaving all your seeds locked up in the barn. They're safe from storms, sure, but pests are slowly eating them away. That's inflation. Step 2, dollar cost averaging. That's like going out and planting just a few seeds each month. Yeah, you'll get a harvest, but you missed out on the best part of the growing season for most of your seeds. And then there's step 3, lump sum investing. That's planting every single seed you have on the very first day of spring, giving them the absolute maximum amount of time in the sun to grow. That is how you get the biggest harvest. A disciplined investor has to completely redefine the idea of risk. The biggest risk isn't that the market might dip tomorrow. The real 100% guaranteed risk is that the cash you're holding onto is losing its value, its actual purchasing power every single day, thanks to inflation. Market volatility comes and goes. The loss from inflation is permanent. So let's lock in these takeaways. These are your new guiding principles. 1. Markets go up more than they go down. It's a historical fact. 2. Because of that, lump sum investing wins about 3/4 of the time. 3. Remember, DCA is an emotional tool to manage regret, not a financial tool to maximize wealth, which leads to the most disciplined action you can take. Get your capital working for you as soon as you possibly can. And the final, unbreakable rule that all of this proves, time in the market is always better than timing the market. At the end of the day, the choice is yours. Are you going to base your financial strategy on decades of hard data or on the temporary feeling of fear? The path to long-term wealth is paved with discipline. Let the math do the heavy lifting for you.